a particular product is sold from India to Sri Lanka. So you can say you are exporting to Sri Lanka. Here look at the 2 points. Origin is India, destination is Sri Lanka. So because the goods are originating from India and reaching the destination is Sri Lanka, right? So here in India we don't collect any tax. I am talking about indirect taxes. So how? For example, they are manufactured in India and excise duty is payable if they are consumed, sold and consumed in India, if they are meant for consumption in India. In this particular context, these are meant for consumption outside India, that is Sri Lanka. So, no excise duty. If at all excise duty was collected, that is refunded in the name of rebate. So, no excise duty. Number 2, no sales tax by virtue of Section 6 of CST Act. Done? And any services are there? No service portion is allowed because the service portion becomes either refundable or no service tax is collected. So then, no tax was collected at the origin. In India, we have not collected any taxes, neither state government nor central government. If at all some tax was collected, that was to be refunded, that has been refunded, that is due to be refunded. So tax-free goods went out of India to Sri Lanka. Sri Lanka is the destination, and immediately the moment the goods reach Sri Lanka, the Sri Lankan government, that is customs department, will impose import duty because for them it is an import. What is export to India is import to Sri Lanka. So Sri Lankan government will impose import duty plus. So when they are sold, again sales tax is imposed in Sri Lanka. If they are further processed and manufactured, excise duty is collected there in Sri Lanka. So all taxes are being collected in Sri Lanka only, destination, not in India at all. Similarly, if some goods come from another country, say from Japan to India, from Japan, the goods come to India tax-free. They don't collect any taxes on Japan, tax-free. But whereas the moment the goods reach India, we impose import duty, blah, blah, blah. So, in the world as a whole, I can tell you, they have made, all the countries, most of the countries have made it a point that their taxation system should be destination based, not origin based. Suppose we, in this particular context, let us say, what is the logic? Suppose we collect tax on goods exported to Sri Lanka. What happens? Tax paid goods are exported. So, because of the tax burden, the cost will be high. So, when the cost is high, we will lose market to our competitors. Somebody else will take on. Because the cost is inflated and naturally price will be more, and the higher the price, the lower the intake. So Sri Lankan people may not purchase from India, instead they purchase from some others. Because of this fear and because of this reason, major reason, almost all countries have made out a scheme of taxation which is destination based. So you understand why the taxation has been destination based. The slogan, let me tell you, there is a slogan: don't export taxes, export only goods and services. That is the slogan, and almost every country is following. Otherwise it will lose its market, it will perish, its international trade will be at peril. Okay, so in indirect taxes there are two major points. One is domestic, it is a tax on domestic consumption. Number two, it is destination based. These two things you have to take care of. Okay, and further.
So now, as you have explained the basics of the indirect taxes, now we are getting the student queries. So structurally moving on, I'll first put on the queries on service tax.
Okay.
First query, as you have mentioned that we have destination based taxes.
Right.
So we students want to know that what are the point of taxation? So please elaborate on point of taxation rules applicable for service tax.
So point of taxation rules, it is a topic. In fact, it's under service tax. So your query is from service tax. The point of taxation rules 2011, they came into operation in 2011. Earlier, let me give you a background first. Earlier, taxation was on cash basis, not on accrual basis. In accountancy, we come across the terms like cash basis, mercantile basis, system of accounting. Similarly, see, on cash basis means you provide a service to somebody until and unless you receive money from him, service charges and service tax, etc. from him, you need not pay. Your tax liability arose only when you received money, either in advance or after completion or during the service that you are providing. But Government of India changed this. In 2011, they changed this scheme to accrual basis. Means whether you receive monies or not, it is irrelevant. Once you provide service, you have to issue invoice, say within 30 days. In the case of financial banking institutions, it is within 45 days. So once you complete service, you have to issue invoice. So the moment you issue invoice, your tax liability arose. That is point of taxation. No matter what happens. So for example, your customer absconded, no more available, or it has become a bad debt. It's not a free service. Free service is not taxable. Suppose for whatever be the reason, he became bankrupt or something happened and you are not able to collect, or it became a bad debt. Still your liability is still there. You still have to pay. Earlier, you were liable to pay only when you received. But now, even if you don't receive, your tax liability arose on the date of issue of invoice, then you have to pay. So, point of taxation rules have been made to this extent to enable the service provider to understand the point at which the tax liability arose. The point at which the tax liability arose. And whatever I said now about invoice is a general rule under Rule 3. This is a general principle. What is the general principle? Service tax liability arises on the date of receiving amount towards the services. Maybe you can call it advance, or the date of issue of invoice, whichever is earlier. So date of issue of invoice or on the date of receiving money from the service receiver. So whichever is earlier, the tax liability arises. But sometimes it may so happen, the service provider may fail to issue invoice, may delay, dodging tactics. For that there is a condition. What is that condition? Every service provider has to issue invoice within 30 days of completion of service. In the case of banking or financial institutions, there is a relaxation. Within 45 days of completion, they have to issue invoice. Then what happens if they don't issue invoice within the stipulated time, say 30 or 45 days, as the case may be? Then date of completion will be taken as date of issue of invoice. So this grace period is gone. Suppose you have completed your service on January 1st and you have issued invoice on 30th January. So within 30 days you have issued an invoice. So your tax liability arose on 30th January. Suppose you completed your service on 1st January but you issued an invoice on 2nd February. So you have taken more than 30 days. So you lose that advantage of this 30 days grace period. So then the tax liability arose on the date of completion, that is on 1st January itself. So means you are deemed to have issued on the invoice on 1st January itself. That is the risk. But there are some special cases also. And Rule 4 Rule 5, Rule 6, Rule 7, like that. Rule 6 is no more, of course. Special cases have been given in other rules. For example, when you provide service like that of intellectual property rights, where the tax liability arises not on the date of performance but at a future date. In such a case, the law will wait. It says when actual payments, actual liabilities start coming, and at that particular point of time, we will see date of receiving payments. When you start receiving payments at a future date of receiving or date of invoice, whichever is earlier, that principle, it is postponed principle under that. And similarly, Rule 4 and Rule 4 is talking about rates. Suppose the rate changes, service tax rate may be changing, then the impact will be there under Rule 4, because we cannot go very elaborately on this, because for Rule 4, to explain even Rule 4, it takes more than an hour. You have to go through and take advantage of the query section. Query section is there, I think between 2 and 3 p.m. every day. You take advantage of that. And 5, payment, due payment, when the payment is said to be made, like that. Rule 6 is no more. And Rule 7 again, it is about special cases, reverse charge cases. You know the concept of reverse charge. Instead of service provider, the service receiver is directly is liable to pay the service tax directly to the government, not through service provider. He himself will pay to the government. He will bypass the service provider. So that is called reverse charge. And in the case of reverse charge, it is the date of payment which is taken. And in the case of services to associated enterprises, in Income Tax Act Section 92A, associated enterprises, it's a big concept under transfer pricing. So, in the case of services provided to, received from associated enterprises, or provided to, as the case may be, the service tax liability arises on the date of book entry or amount received, whichever is earlier. So, like this point of taxation rules, they are fixed so as to pinpoint on which particular date the tax liability arises, so that from that particular point the due date can be confirmed. For example, your tax liability arose on 1st January. You are a sole proprietor. Next quarter, your tax liability payment due date, January, February, March, 31st March will be due date. Like that. So, to ascertain the due date for payment, it is necessary to ascertain the day on which the tax liability arose. Point of taxation rules point out that. Okay.